The cost and fees of what you invest in have a great impact on your returns, and I want to prove that to you today. Maybe you're thinking, well, Fund A only has 0.5% more fees, annual fees, than Fund B. What could the difference be? Could it really be that bad? Well, I'm going to show it to you today. If you're new to my channel, my name is Rebecca and I make videos about personal finance, things like investing, saving, all of these very important topics that I guess most of us start learning about in our 20s. So if you're not yet subscribed to my channel and you want to learn more about these topics of personal finance, hit the subscribe button and let's start straight away with the costs of your investment. Okay, let's start easy and get an idea of what the impact of fees could be. Let's say you have 3 funds to choose from. One has an annual fee of 3%, the other one of 2%, and the last one of 1%. And let's say you make an average return of 7%, which is, by the way, realistic. Okay, let's say you want to invest $100,000. And maybe that sounds ridiculously high. Okay, well then let's say in 5 years you have $100,000 to invest. And after you invested them in the funds, you do nothing. You just let it sit and wait for 30 years. What will happen? Well, if you choose Fund A with the 3% of cost, that means your fund will be growing at a rate of 4% each year. So the 7% minus what you pay in fees. And you will have $324,000 after the 30 years. What about if you choose Fund B with the 2% of fees? Well, after the 30 years, you'll have $432,000. And if you choose the last fund with the lowest fees, you will have $574,000 after the 30 years. The difference is over $100,000 from fund to fund. And if you compare Fund A to Fund C, you would almost have double the money at the end of the 30 years. To me, that's a huge difference. So we cannot say it's just 1% higher. It's not just 1% higher. That has a great impact on your return. $100,000 is a lot of money, but if we're looking at the example, we see that we could be paying $100,000 or more in additional fees that we could be saving. And the difference is even higher with bigger numbers. So let's say you invest $500,000 for 20 years. With the 3% fees, you would have $1,095,000 after 20 years. With 2% fees, you would have $1,326,000, and with only 1% fees, you would have $1.6 million. So that does make a big difference. Maybe the example for $500,000 seems very high, but I want to take into account that as we invest, our money grows, and then at some point you will have $500,000. And for the remaining time from there till your retirement, you do not want to be paying unnecessary fees either. And that could be the amount of fees that you are paying depending on the fund that you have chosen. As you might know, actively managed funds like mutual funds have a much higher cost than index funds or ETFs because you obviously have to pay the fund manager. However, studies show that most of the mutual funds underperform, which means that they give you a lower return than the market, than maybe an index, for example. There's one study I saw that said 80% of them underperform. So of course there will always be some golden mutual funds that outperform the market. But what are the chances of you picking the right fund and that fund actually outperforming the market for a length of time and not only for 1 year? Since that is what data suggests, I recommend to buy into index funds, especially if you're starting out with investing. If you want to invest in an index, you have to know that for one index, there can be dozens of index funds, like here. All of these funds imitate the same index, but still their expense ratio can be wildly different. By the way, the performance and risk can also vary between these, but especially the costs set them apart. Let's take the S&P 500, for example, the 500 biggest companies in the United States. So, for all of the funds that track the S&P 500, the average expense ratio is 0.62%. The cheapest, or one of the cheapest options, is Vanguard, and it has 0.025% of annual fees. And one of them even charges 2.28% of annual fees. That is just ridiculously high for an index fund. But now let's look at the difference it would make. What would the difference be for 0.5% in the fees. So let's say you have only two funds that you like. One has a 1% fee and the other one has an annual fee of 0.5%. And let's take the investment of 100,000 again. We know that after 30 years for a fund with a fee of 1% will get you 574,000. And if that fund only costs 0.5%, then your 100,000 will have turned into 661,000. So even such a small difference in fees has a huge impact. There's one last and very important thing I want to mention in this video, and that is the expense ratio that is disclosed for all of the funds is not the only cost that is lowering your return. There's many other costs like transaction costs, tax costs, exchange fees, account fees that all lower your return. Let's take transaction fees, for example. These are the costs that incur because your fund will trade over time. That means in a mutual fund, you have a fund manager actively managing the fund, buying and selling things inside the fund. He's maybe buying some new stocks and selling other stocks and bonds that are more risky or have proved not to return over time. So all of these transactions always cost something. And yes, an index fund has much less trades, but the index fund is mirroring the index. So that means if the index changes, then the index fund will also change things around to match the index again. So this is just one example of the hidden fees. I don't want to go into too much detail. I think it's just important to know that the expense ratio that you're looking at is not the only cost. If you want to learn more about it, I can recommend the book Money from Tony Robbins, and he has a chapter on fees. But I will also link an article down in the description box that explains some of the fees. If you want to find out the true cost of the fund that you want to invest in or that you are already investing in, you can check out personalfund.com. I will link it down below. You can look for your fund there. I have to say it does not have all of the funds, especially if you're looking internationally, but most of the US funds are in there. I personally would never invest in a fund that is over 0.5% of fees, and so that just limits it down for me, and then I can choose funds going from there. And in his book, Tony Robbins recommends to keep your total cost for investment under 1.25%. So that already includes fees that you might be paying for financial advisors, then the annual fees for your funds and all of that. So all combined should be under 1.25%. I hope you liked this video, and I hope it could help you understand that fees are very important when it comes to choosing a fund. Obviously, the performance, risk, and type of fund is very important, but fees come hand in hand with the performance. If fees are super expensive, that means your performance will be down. I will link my investing playlist right here if you want to watch more investing content, and I will see you in the next video. Bye!